about your company, where we dig deeper so you invest smarter.
Hello and a warm welcome. You've joined us on All About Your Company right here on ET Now. I'm Ashesha Advaryu, and today on the show we are going to put the spotlight on Lloyds Engineering Works. Now remember, the company has undergone a lot of restructuring over the last few years, but the outlook of the management continues to remain very positive. So what makes them this confident, and what are the growth levers? We'll discuss all that and more over the course of the next 30 minutes. But first up, let's take you through the key talking points that we will focus on. Now, the order book as on the 31st of March 2026 stood at about 8,300 odd crores. What is the management aiming for in FY27, and what's the growth guidance looking like over the next 3 to 5 year period? That will be the most important question that we will be trying to get the answer to from the management, who will be joining us in just a bit. Now, remember, the company caters to products and services across industries. But we believe commodity price volatility will be a concern for the industry. How big is that a concern for the company? And is that likely to weigh heavy on the margin profile of the company? That is also an important question. Other than that, the company has expanded its margins considerably over the last 5 years. Is that sustainable? We'll try to get answers to that from the management as well. Let's also put the spotlight on a couple of other tie-ups that the company is focusing on. The company says that the company is looking to accelerate defense tie-ups. What will that be for, and is it margin accretive, and are margins for defense tie-ups higher as compared to other industries? We'll talk about that as well. And the company has a net cash balance of about 380 crore rupees. What will the utilization strategy be? That is another important question. We'll try and get answers to all of these in just a bit. But first up, let's talk about the company and what the company really does. The company was established in 1974. It has engineering business. The engineering business, in fact, specializes in heavy equipment, machinery and systems. It caters to several businesses, and we'll talk about that in just a bit. The products are tailored to meet stringent requirements across industries, and it has a comprehensive portfolio of several products and services. Let's also talk about a couple of other parameters then. And we have a company that caters to hydrocarbon, oil and gas, the steel sector, nuclear power plants, marine, EPC. These are some of the sectors that the company caters to. It has been doing that over the last few years, and that is likely to continue. Now, remember, the company also has a marquee clientele. It has companies like Garden Reach Shipbuilders from the defense pack. We also have Cochin Shipyard, Mazgaon Dock, Aditya Birla, Utkal, and Lumina. These are some of the companies that this company caters to. Coromandel International, Reliance Industries, GAIL, HPCL, BPCL, and a whole host of companies from the oil and gas sector. So these are some of the marquee clients that the company has in its portfolio. That's as far as major clientele is concerned. Let's put the spotlight on the financial performance of the company over the last few years. And as I mentioned earlier, the company, remember, has undertaken a lot of restructuring and merger over the last few years, and that is the reason we have seen that sharp spike up come in the company's revenue profile over the last few years. From revenue of about 312 crores in FY23, it has gone up to nearly, we have 3,200 crores of revenue that the company reported in FY26. And FY26 versus FY25, we have seen a solid jump up as far as revenue is concerned. And this, as I mentioned, is on the back of some integration that the company has done, merger that the company has done. And that is the reason we have seen a sudden spike in the financials of the company. As far as EBITDA is concerned, that too has reported a very strong CAGR over the last 5 years. From EBITDA of just about 29 crores in FY23, it rose to about 160 crores in FY25. And to nearly 500 crores in FY26. That's the kind of jump up that we have seen in the company's EBITDA profile over the last 5 years. Let's also talk about the margin picture then. And margins too have expanded over the last few years. In FY26, we did see some bit of decline, and we'll try and ask the management as to why the margins have declined to 15% from 20% that the company reported in FY25. But it is important to note that margins were below that 10% mark in FY23, and since then they've expanded substantially to about 20% in FY25. So that's as far as the margin picture is concerned. Let's also talk about profitability. From 37 crore profitability in FY23, it has risen to more than 330 crores in FY26. That's the kind of jump up that the company has reported in its profitability over the last 4-year period. And the CAGR for net profit actually stands at 173%. But the most important aspect is the order book profile. The company's order book as on the 31st of March 2026 stood at more than 8,300 crores, and this is what makes the management very confident on revenue visibility and the outlook of the company over the next few years. Remember, the order book stood at just about 400 crores in FY23 and now stands at more than 8,300 crores as on 31st March 2026. So that's as far as the order book trend is concerned over the last few years. Shifting focus to the cash flow profile then, and this has been quite volatile, and this is also because of the restructuring that the company has undertaken, where cash flow from operations has been in negative territory in FY23, slipped back to positive in FY24, and again in negative territory in FY25. We also have a couple of other adjustments which you can see in the graphic plate on your screens, but clearly this part of the business has been very volatile because of restructuring and the accounting adjustments that the company has done over the last few years. Let's also talk about the cash position and the borrowings then, and the company has net cash position. We have the book value which stands at about 1595. And profits and reserves have also risen substantially over the last few years on account of the profits that the company has been making from FY24 to 25 and now in FY26 as well. As I mentioned, borrowing is a negligible 81 crores as on 31st of March 2026, and the company has a net cash balance, and the cash and bank equivalent stood at about 380 crores at the end of FY26. So what will the utilization strategy be? That is also another important question we'll try and get answer to from the management, who will be joining us in just a bit. Let's also talk about the return on capital employed. From 9% in FY22, look at the sharp spike, 28% in FY23 and 24. It has dipped a little bit in FY26, but this of course will be on the back of the adjustments that they've done on account of the integration of one of its associate companies, and that is the reason we could be seeing some bit of decline when it comes to return on capital employed. Let's talk about a couple of other parameters then, and we'll talk about the shareholding pattern. Promoters have held about 56% till the end of last year. It has come down to 42% at the end of 2026. What led to that? We'll try to get answer to. FII shareholding has risen to about 2%. DIIs have been holding just about 0.2% in this company, and public shareholding stands at about 52%. So that's the shareholding pattern for Lloyds Engineering as on the 31st of March 2026. We did talk about order book position, but we try to break it up here, where infrastructure segment order book stands at about 5,700 odd crores, engineering order book at 2,500 crores, electrical engineering at 150 crores, which totals to about 8,500 crore of order book that the company had as on the 31st of March 2026. So that's the order book profile, which is what makes the management very confident. Let's try to understand where is the company getting the orders from. It got about 613 odd crore order from SAIL, which is Steel Authority of India. It got repeat orders from a number of marquee clients like Reliance Industries, AMNS, we have HPCL. They also won a couple of orders from railways, defense and power sector. So these are the industries that it caters to, and this is what is generating new order wins for the company, which is reflected in the order book position that it has. Let's also talk about defense tie-ups, and remember, the company is very bullish on the defense tie-ups that the company has. The company is looking to supply to various sectors, including drones, radar, naval systems, underwater. So these are the segments that the company wishes to cater to when it comes to the defense ecosystem. As far as electrical engineering is concerned, the company is also expanding capacities in motors and pumps, and it has also expanded into elevators and escalator segments. So that is another segment within the engineering segment that the company has been focusing on. So that's as far as the financial performance is concerned, what the order book position looks like, and what the outlook is going forward. But to understand that in greater detail, we are now joined by Mr. Krishna Gupta of Lloyds Engineering. Mr. Gupta, afternoon. Thank you so much for taking your time out and joining us here on ET Now. First up, it's difficult to analyze the financials of the company given the restructuring that you have undertaken. If you can take our viewers through what has transpired so far, what has the journey been, and what makes you so confident on the coming 3 to 5 year period.
Thank you so much for having me on the show and a very nice summary that you've laid out for the entire organization and how we've grown over the last few years. I'll just talk firstly about the sustainability of our revenue and growth prospects. So we're actually one of the only engineering companies in the country to be in multiple verticals and to be heavily involved in each vertical. We have a good presence in our steel plant vertical, in hydrocarbon, in port equipment, energy, civil, naval, and defense. And now with our mergers and acquisitions, we're also strongly involved in infrastructure, structural fabrication, electrical engineering, elevators, and escalators. So that gives us a good opportunity to be involved across multiple sectors at the same time. And within each vertical, over the last few years, we've actually spent our time in developing a good foundation in terms of team management, creating a core team for projects, execution, marketing, and quality purposes. The benefits of this, we've seen it in some of the verticals this year, but in the coming years, we will continue to see the growth and further take advantage of the foundation that we've already built so far. And further, we're also focusing on key collaborations with technology suppliers, providers from around the world in different segments. This helps us to give us a strong position with inquiries within India and using the Make in India policies with the technologies that these companies have developed over the years. It gives us a very good place to sustain and to expand on our current trajectory. Our standalone growth has been 40% year on year. And this year, we have a current order book of 3,000 crores, which is quite significant. And we expect to have good execution this year. Lloyds Infrastructure, which is a part of the mergers that we're looking at, that has grown 80% year on year to 2,000 crores this year. And that has a current order book of north of 5,000 crores. And other than that, we also have Techno, which is the electrical engineering. Within a year itself, we've seen a 20% growth. And we've just stabilized our teams over there, hired senior positions, and built on a lot of certifications and focusing on a lot of capex and investment over there to take advantage of what we built and the market, which is up and ahead. So to directly answer, I think our growth is fairly sustainable, and we're looking at a much larger growth in the coming years. And our order book gives us a 2.5x visibility of revenue.
Right. Mr. Gupta, I understand that you're very confident, but can you quantify that for us? 8,350 crores of order book as on 31st of March 2026, and you're telling us that the growth is sustainable going forward. But what kind of order inflows are you penciling in for FY27 and 28? Can you put some numbers into perspective for us?
Definitely. We're targeting on our steel market a very strong position. We have a lot of inquiries ongoing with, for example, with SAIL is one of them, with other steel companies, and our collaborations with various technology providers supporting us to further strengthen our position in India as a key manufacturer, supplier, and EPC contractor for the steel business. So we're targeting a good growth in the steel sector. We're seeing customers from around across the country and various components of the steel manufacturing process come to us as inquiries. So our steel vertical is looking at considerable growth. Hydrocarbon, we're looking at a lot of repeat customers and repeat orders from our existing customer base, which is EIL, HPCL, RIL, and others. LICL, we have a very strong order book of 5,000 plus crores, as I mentioned, and that's looking at the next few years to convert that. And Techno, which is a very small part of the entire pie, but we are looking at a very big growth over there because there's a lot of redevelopment, new projects, new capex by the railways, by metros in tier 1, tier 2 cities, as well as we're strengthening our manufacturing capabilities for HT motors. And in the next few months, we'll be capable to deliver a large quantity of HT motors, which will contribute to a good part of our top line in the coming years.
Right. So from about 3,350 crores of revenue that you reported in FY26, how much growth can we pencil in, and where do you see your revenue 3 years or 5 years down the line?
We're looking at a strong double-digit growth every year, and we should really look at doubling this number in the next few years on the safe side.
Mr. Gupta, also wanted your thoughts on the volatility of margins that we have seen over the last few years. From below 10% in FY22-23, they rose to about 20% last year, but they've again come in at 15% in FY26. Are raw material prices volatile for you? Is that a concern?
That is a small part of it. A bigger part of it is the EPC and infrastructure business from LICL, which we merged in. The EPC and infra business usually runs at about a 13 to 15% margin, and we're building on all other verticals to capitalize on our technologies in the niche segments to scale up and contribute towards the higher margins. So, for example, in our steel business, we have a few very critical technologies which are exclusive to us, and those will demand and give us higher margins. And we're working towards a 17 to 18% margin and moving towards a 20% margin in the next few years.
Mr. Gupta, I believe you're also looking to increase your tie-ups within the defense sector. Is this true, and is defense contributing more to your margins as compared to other segments of the company?
So as a company, we've been into the defense business for the last 25 to 30 years. Earlier, we were only supplying naval equipments to Navy and Coast Guard ships. These are very critical components, which are steering gears and stabilizers, which move the ships and which stabilize the ships in their requirements. Up until the last few years, there were no new orders coming in for us to take on. 2 years ago, we took on a new order in a big way. Currently, we have orders for about 17 ships. Each of them, we're doing steering gears and stabilizers. And we're looking to double down on this because the Navy and Coast Guard has projected to us that in the next 5 years, there's going to be 200 to 300 new ships being built in India. And we're one of the only key suppliers for these two critical components. So in our existing components, we will look at a very strong growth. The initial margin in the initial orders might not be as much, but as we build a team, indigenize components, and work on our local developments and R&D facilities, we will definitely increase our margins. We are also looking at very strong collaborations. We've collaborated with an Italian giant who's one of the largest shipbuilders in the world called Fincantieri, and we've collaborated with them with 3 to 4 key components currently which are not made in India, and we will be one of the first companies to make them in India. And as we progress into this, this will help us to get large volumes as well as large margins. We've also moved into other verticals of defense because we see this as a very important and a large growth segment. And we're doing collaborations with some European companies on drone technology, radar technology, and other critical technologies. And using our same model, what we've used with a lot of our other partners, to use their technologies, do a technology transfer, follow the Make in India policies, make it in India, and offer the best technologies at a competitive rate to the Indian defense segment.
So what will your target margin profile be from 15% currently? What will it look like 3 years down the line?
We should move towards 20%, but we would be strongly going up 1.5 points every year is our target.
Understood. And the 8,350 crore of order book that you're sitting at, what will the execution timeline be?
So in LEWL, which is our existing business, we have usually a 10 to 12 month cycle time on any projects. The steel plant projects for larger orders go between 24 months. So the current 2,000 to 2,500 crore order book we have on our standalone business, we would look at a 2 year horizon to completing that entirely. Along with that, we're looking at getting new orders in the first quarter of this year. Whatever we get in the first quarter of this year, we will target to complete within this financial year as well. In Lloyds Infrastructure, we're targeting out of the 5,500 odd order book to complete about 60 to 70% of that in this year, if not more. From Techno, we're targeting close to 250 plus crores this year, which is again a significant jump from the last year.
Understood. And while we were analyzing the balance sheet of the company, I believe you have cash balance to the tune of about 380 odd crores. How do you aim to utilize this?
We're targeting at investing and purchasing some key assets and land, which is going to help us to fuel our further growth within our different sectors and verticals. So we've identified some lands in near Raipur and in Ahmedabad as well, where we're looking at strategic locations which are beneficial from a logistics point of view as well as customer point of view and our capabilities as well.
Promoter shareholding, Mr. Gupta, has come down from more than 50% to just about 42% now over the last 1 year. What is that because of?
We had done an issue in the last year, and we're targeting to keep it steady at this rate. The main requirement was to fund a lot of acquisitions and purchases of land, working capital, and for general GCP as well.
Understood. And out of all the services and the industries that you cater to, whether it is defense, whether it is engineering, you also cater to oil and gas. Which segment of among all these is most margin accretive, and are you focusing on that segment more to expand your margins?
So within each segment, there is a high margin and a low margin business. Currently, we're in the middle where we have some, or rather, we have a larger component of low margin, but we are focusing on our technologies because I can give you one example. In our steel vertical, we've purchased a technology exclusively for global rights minus China for a process called eco-pickled steel. This is a process of pickling of steel without acid. So it's a very eco-friendly solution, which is lower on capex for the end customer, lower on opex for the end customer. And once we do this, give this solution, it's a very high double-digit margin. So things like this is what we're working on within each vertical. Steel plant, we have 3 to 4 different technologies. Oil and gas, we have a few collaborations as well. So we're moving towards capitalizing on the technologies we already have in hand to move and to give us a higher margin.
I also wanted your sense on the heat exchangers business. How much revenue do you generate from this particular segment, and do you intend to scale it up going forward?
It's a small part of our entire big pie, but definitely we do intend to scale it up. Our main focus is on our existing order book and our existing teams. As you've seen, we are into over 10 sectors. Managing 10 sectors, teams, manpower, and all of that is very crucial at this point. And we see a lot more business, a lot more demand, and a lot more value in our existing segments, which is the steel vertical, hydrocarbons, civil, EPC, defense, and our techno, which is the electrical engineering. Once we stabilize this, have a good execution capabilities, have good order books at hand, then we will focus on expanding our other verticals as well.
Since we are talking about expanding into other verticals, and also because you have a very strong balance sheet position, wanted your thoughts on whether you're looking to enter the high voltage transmission and HVDC ecosystem.
Not at this stage. Like I said, we have our hands full with what we're doing, and we're focusing on really converting and reaching a very strong double-digit growth on both top line, but while also maintaining a very healthy EBITDA and PAT percentage as well. Once we achieve that consistently for 3 years, then we will look at expanding into other verticals.
Right, we get that point completely. And congratulations and all the very best for your future, Mr. Gupta. Thank you so much for taking your time out and joining us here on ET Now.
Thank you very much.
And with that, it's a wrap on this edition of the show. Thanks so much for tuning in. More news and updates will continue on the other side.